While Federal Reserve tracking data suggested a multi-billion-dollar contraction in bank MBS holdings this quarter, the underlying call reports show that portfolios actually expanded. This chart tracks Q2 net additions across the 500 largest banks. It shows an aggregate addition of $4.4 billion in pass-throughs and $4.1 billion in CMOs. This momentum was strongest outside the megabank tier. Institutions outside the top 50 added $5.4 billion to their portfolios, outpacing the $3 billion added by the largest 50 banks. These numbers confirm that institutional appetite for agency MBS remains high, with regional players providing the primary support for the market. Examining the specific asset types driving this growth reveals a significant shift in how banks are managing their pass-through holdings. This chart maps that shift. On the right, Ginnie Mae holdings grew by $9.2 billion, while on the left, conventional holdings dropped by $4.8 billion. This decline in conventionals isn't active selling, but passive runoff in hold-to-maturity portfolios. Banks are replacing that conventional runoff with Ginnie Mae's, which offers 0% risk weighting and higher yields. By moving into government-backed Ginnie Mae's, regional banks are lowering their capital requirements while maintaining their exposure to the mortgage market. However, at the top tier, the largest megabanks are executing drastically different strategies rather than moving as a uniform group. This comparison table shows the range. Citigroup added $12.1 billion in agency MBS, while Bank of America reduced its position by $12.4 billion. This divergence continues in treasuries. Wells Fargo added over $23 billion, while Bank of America offloaded $20 billion. Outside of securities, this chart shows that bank holdings of residential loans surged by over $19 billion this quarter. There is no single top-tier playbook right now. Large institutions are following individual strategies while shifting significant capital into core residential lending. Commercial trading accounts saw significant reductions this quarter. JP Morgan's pass-through holdings dropped by $13.3 billion, and Wells Fargo reduced its trading balances in both pass-throughs and CMOs to zero. These figures only represent activity at the commercial bank level. They do not include dealer entity activity, which is reported separately. The full extent of dealer risk-taking will be detailed when holding company reports are released in the coming weeks. While regional banks provided a floor for MBS demand this quarter, the total trajectory of institutional liquidity will depend on the upcoming holding company data.